basic debt servicing stability condition is that your primary surplus, your primary government surplus, should be greater than or equal to your nominal interest rate minus your nominal growth rate times your debt to GDP ratio. If it's not, your debt to GDP ratio threatens to climb and your finances will spin out of control. Let's look at how that effect is actually demonstrated by looking at some real world examples. In the United States, we take the nominal GDP of 5.6, they got a 10-year bond of around 2. Today it printed the lowest ever. 1.9 was the auction, which is a remarkable outcome in a world where the U.S. is running 3.5% inflation. But in any event, if we run that through the equation, you're looking at a situation where the United States needs a fiscal adjustment of about 5% in order to balance its books. Greece is where Russia was. The market has basically given a vote of no confidence to Greece, and what the equation suggests is that based on where they are today, having to issue 10-year bonds, north of 20%, they need a fiscal adjustment of close to 50% of GDP. That ain't going to happen. They're going to go bankrupt. The important thing on this chart, though, is that every one of those countries needs to undertake a substantial fiscal adjustment and needs to do it quickly. Otherwise, they run the risk of the markets losing confidence in their ability to issue and manage debt. The higher these numbers go, these debt to GDP numbers go, the more dire the problem becomes. Isn't it interesting that in the last 20 years, since the fall of communism, we've seen a complete reversal in the financial condition of the communist world and the capitalist world? We're all tapped out. But China and Russia, wow, they're at the bottom of the chart. They've got the strongest finances of any of the countries in the world, which is why when the head of the European Financial Stability Facility recognized that the EFSF, the European Financial Stability Fund, the bailout fund in Europe, needed more money, he said, I'm going to China. Well, it's kind of crazy to announce who you're going to raise money from. If you're an investment banker, that's a complete no-no. But he took his tin cup and he was going to go to China because that's where the money is now. It's a remarkable reversal, and it has deep, deep geopolitical significance if we don't get out of this debt mess. Here's the net interest margin chart. It was hiding. But as you can see, in the previous cycle, where we had a very severe recession, the Fed reeled out credit, was in the early 1990s, the net interest margin went almost up to 5%. We're tracking at below 3.5% right now, and it's not getting any better. So the pace at which U.S. banks can replenish their balance sheets is not as great as it was in the past, and that is a risk in the system. Let's look at what's happened here. In previous cycles, in the United States, we had an average of about 3% drop in the economy in a recession. And we had an average of about 3% combined fiscal and monetary stimulus relative to the size of the economy engineered by the Fed and the Treasury. In this last cycle, what they did was they dumped in about 50% of GDP. It's a huge stimulus program, but so far it hasn't produced any meaningful growth. Again, I refer to the headwinds. But what that has done is it has created a lot of monetary tinder, dry tinder, that at some point, if velocity picks up, could result in accelerating inflation. Again, that would be a black swan. It's something that the authorities aren't counting on. But given the size of the stimulus, which is historically unprecedented, there is a huge amount of dry tinder in the system that could potentially thwart the objectives of the authorities to exit from the debt crisis and to restart economies, restore financial health, get income and spending into line in Europe and the United States, such that we don't blow up not too far down the track, because that's where all these numbers are leading us. Now, The scale of the problem is exacerbated by the fact that there are huge cross-border claims. And this is what's making the situation in Europe extremely tricky to navigate through. This is why they've stretched out the restructuring of the Greek economy. This is why they've stretched out the inevitable exit of Greece from the Eurozone. Because Greece owes a tremendous amount of money to key banks and key governments within the Eurozone. So does Italy, so does Spain. And the problem is that these liabilities, these obligations are on the books now and need to be dealt with. They can't be easily restructured. So the European authorities are extremely afraid right now of contagion spreading from Greece to Spain to Italy. The unfortunate thing is that their policy of incrementalism, of taking things slowly, which has largely been driven by a bank agenda that doesn't want to see themselves take losses, that policy of incrementalism has actually created the conditions for this contagion to take place. When we were asked what to do with Greece about 2 years ago down in Washington, we told them that Greece needs to default and have a soft exit from the Eurozone. Had Greece defaulted back in 2010, they would have had to have taken a chop of about 20% on their debt. Well, the lenders would have. And Greece could have exited the Eurozone, restored the drachma, negotiated conditions whereby they could re-enter the Eurozone in 5 to 10 years subject to some economic hurdles. And we wouldn't have even been talking about the Spanish contagion, the Italian contagion. Instead, what the choice was made to bail out Greece, ply it with more debt, in other words, increase the exposures you see on this table, right? And now we're at the point of inevitability where last week Sarkozy and Merkel as much as admitted that Greece is going to have to leave. They're talking about a 50% haircut for Greek debt. That haircut is only going to be applied on domestic Greek debt. And Greece, following this negotiation, will be left with a debt-to-GDP ratio of around 130%, with a repayment plan that will see it at 120 in 10 years. That is unsustainable. It can't happen.